Do you ever find yourself daydreaming about retiring early? It's definitely a common goal, but achieving it requires a steady stream of passive income. You might be thinking that working a 9-to-5 job and saving for your 401k is the way to go. But the truth is that relying on a pension plan won't cut it if you want to retire early and maintain your current lifestyle. I mean, having a pension plan is great, but it's not going to provide you with the financial freedom to live luxuriously during your retirement years. So have you thought about other ways to build a reliable passive income stream that'll allow you to enjoy your golden years to the fullest? In the world of dividends, you can buy some shares of a company and watch your money grow as you receive a cash reward deposited directly into your account on a monthly or quarterly basis. With these dividends, you can adjust to a job you love, work part-time, or spend more time with your loved ones. But you may be thinking, well, I don't have millions of dollars to invest in the big companies listed in the S&P 500, for example. Well, I'm here to show you that it's possible to live off dividends without breaking the bank. Let's take a closer look at Johnson & Johnson, J&J. J&J is a well-known company that produces a wide range of consumer healthcare products. At the time of filming, J&J was trading on Seeking Alpha for $151.43 per share. The company pays an annual dividend amount of $4.52 per share, which translates to a 2.98% annual dividend yield. In simpler terms, if you're hoping to make $2,500 per month in passive income from J&J dividends, you would need to own 6,637 shares. Hence, you would need to invest $1,005,072 per year. However, keep in mind that dividend investing is a long-term strategy, and you don't have to invest this entire amount all at once. You can invest a smaller amount regularly over time and let the investment grow. One of the downsides of dividend investing is that it can be a slow process, so it may take a while to accumulate enough shares to live off of dividends. Even if you start early, it's unlikely that you'll be able to retire early using this method. However, if you're patient and consistent, dividend investing can be a good way to build long-term wealth and generate a reliable source of passive income. Since Johnson & Johnson takes a long time, the next option is to consider investing in a higher-yielding type of investment. Let us take a look at another popular stock called Realty Income Corp. It's a real estate investment trust, which is a business that owns income-producing real estate and is required by law to pass 90% of its earnings back to its shareholders in the form of dividends. It currently yields 4.79%, which is better than most consumer staple stocks like Coca-Cola, whose yield is 3.10%. According to their website, Realty Income has grown its dividend for 95 consecutive quarters, making it one of the safest REITs. Let's say you want to earn $2,500 in passive income per month from Realty Income Corp. We'd take $2,500 and divide it by 3.04, which means that you'd need to buy 822.4 shares. To determine the amount of cash needed to secure these shares, we would multiply 822.4 by $63.72 per share, which gives us $52,803. This is the amount you need to invest in Realty Income each month to earn $2,500 in dividend income. Therefore, you need to invest $633,636 per year. Remember, you can earn this income by making smaller investments over time. Moving on, the Altria Group Incorporated, symbol MO, is an American company that manufactures and sells cigarettes, tobacco, vape products, and alcohol. It currently offers a massive dividend yield of 8.12%. At the time of the making of this video, it was paying $3.76 in annual dividends per share. You'd need 7,978.7 shares to make $2,500 per month. The current share price is $46.32. This means that the total investment capital you would need is $30,797.80 per month, which translates to a $369,573.60 annual investment. As you can see, this amount is significantly less than that of the companies we've discussed before. The big question is, what investment can provide a higher yield while still maintaining minimal risk? In my opinion, the best option for people who want to make a living off of dividends sooner is covered call ETFs. Covered call ETFs are a way for investors to make some extra money by selling call options on stocks they own. The ETF buys a bunch of stocks and then sells call options on them to make more money. This is called a covered strategy because the ETF already owns the stocks it's selling options on. This strategy can limit how much money the ETF makes if the stock goes up a lot, but it also helps protect the ETF if the stocks go down. Covered call ETFs can be a good way for people who want to make some extra money to invest in a bunch of different stocks at once while protecting their investments from market volatility. And here's proof of how effective they are. Research by the SIBO showed that the at-the-money covered call strategy generated an amazing 830% return between 1986 and 2011. The reason why this technique works so well is that the value of S&P 500 covered calls actually increases as market volatility, as measured by the VIX, goes up. So not only do you get to protect your investments, but you also get to make more money. It's a win-win. And that's what makes covered calls a solid choice for those looking to make a good return on their investments. So if you're looking for an ETF that can help you weather market volatility while still earning a profit, you might want to consider the Global X NASDAQ 100 Covered Call ETF, QYLD. This 12.72% yielding ETF is the go-to source of passive income for investors. Now, assuming you want to earn $2,500 per month from Global X NASDAQ 100 dividends, we need to work backwards from the annual dividend yield and the current share price. We know that Global X NASDAQ 100 ETF is offering a 12.72% annual yield, so we need to calculate how much we can earn per share. We can set up the equation as 0.1272 equals annual dividend per share divided by $16.61 times 100%. Solving for the annual dividend per share, we get $2.11. Which means that for every share of Global X NASDAQ 100 that you own, you will receive an annual dividend of $2.11. So, to earn $2,500 per month from these dividends, we can set up another equation. Monthly dividend income equals the number of shares owned times the annual dividend per share divided by 12. We want to solve for the number of shares we need to own, so we can rearrange the equation as follows. The number of shares owned equals monthly dividend income times 12 divided by the annual dividend per share. If we plug in the values, we get that we would need to own approximately 14,161 shares of Global X NASDAQ 100 ETF to earn $2,500 per month from their dividends, assuming that they're offering a 12.72% annual yield with a current share price of $16.61. So you need to invest $19,601 per month to earn $2,500 in monthly revenue, which means investing $235,212 annually. Another popular covered call ETF we'll look at is the Global X S&P 500 Covered Call ETF XYLD. It's yielding 13.48% per annum with a current share price of $40. To calculate the number of shares required to earn $2,500 per month from Global X S&P 500 Covered Call ETF, we can use the current share price and the annual dividend yield. First, we calculate the annual dividend per share by multiplying the current share price by the annual dividend yield. In this case, Global X S&P 500 Covered Call ETF is offering a 13.48% annual yield, so the annual dividend per share is $5.45. We can then use this information to determine the number of shares required to earn $2,500 per month from the dividends using the formula monthly dividend income times 12 divided by the annual dividend per share equals the number of shares owned. Substituting in the values, we get that you would need to own approximately 5,495 shares of Global X S&P 500 covered call ETF to earn $2,500 per month from their dividends, assuming they're offering a 13.48% annual yield with a current share price of $40.42. This means that you would need to invest $18,508.90 per month to earn $2,500 in monthly income, which means you would need to invest $222,106.80 per year. Both the Global X NASDAQ 100 ETF and the Global X S&P 500 covered call ETF offer investors a way to gain exposure to the U.S. stock market. However, the differences in their investment strategies make them unique and intriguing investment options. The Global X NASDAQ 100 ETF focuses on large non-financial companies, mainly in the technology sector. The companies included in the ETF have a strong presence in the U.S. market and are among the largest and most successful in the world. The technology sector has been one of the best performing sectors in recent years, and this ETF offers investors an opportunity to invest in the companies driving its growth. In contrast, the Global X S&P 500 covered call ETF employs an options strategy to generate additional income from its holdings. The ETF sells call options on some or all of its holdings, which can generate additional income for the fund. This strategy can potentially reduce the volatility of the ETF's returns and provide a steady stream of income for investors. However, this strategy may also limit the upside potential of the ETF's returns, as the call options limit the gains that the ETF can make on its holdings. Keep in mind that while covered call strategies can offer enticing yields, there's a need to understand their limitations. These tactics tend to perform best when the market is down, as the written option contracts can help offset losses. However, in strong bull markets, the strategy's capped upside potential means it may not keep pace with the benchmark index. The sweet spot for covered call strategies is in sideways markets, where their unique approach to generating income can lead to both outperformance and positive returns. Unfortunately, such market conditions are rare, which means investors must carefully weigh the pros and cons of implementing this strategy. While high yields can be tempting, they come at a cost. Investors must be willing to accept the possibility of underperformance in certain market conditions in exchange for the potential income. Ultimately, the decision to use a covered call strategy comes down to a careful balancing of risk and reward. We all want future financial freedom, and dividend investing is a step in the right direction.